and start our introductions. So hello, everybody. I'm Janet Alder. I am an associate professor in the Department of Neuroscience at Robert Wood Johnson Medical School, and I'm also an assistant dean in the School of Graduate Studies. And I realize that many graduate students and postdocs and others are concerned about how to manage their own personal finances. And so we've had one session already on sort of budgeting and how to, keep your finances under control. And then there was, by chance, a request and an outreach from Fred to do another session that's focused on long-term financial investments and securing your financial future. So I'm very grateful to Mike McCormick and Fred Hoffman for helping us with this workshop today. And I'm going to introduce them both. Then they're going to give their presentation. Please, if you have any questions along the way, just type them into the chat and I will be the moderator and ask questions. We should make this as interactive as possible. So no need to wait until the end for your questions. And then we will have time in the last 15 minutes or so for Q&A. So just to get us started, Mike McCormick is a portfolio management associate at the Sweeney Group at Morgan Stanley. Mike's core responsibilities include account maintenance, client service, and portfolio management / implementation. Mike graduated from Rutgers Business School, yay, an alum, and has been at Morgan Stanley for 4 years. And Dr. Fred Hoffman.
Oh, skip the doctor.
Professor Hoffman was previously a managing director and the head of corporate credit strategies at Napier Park Global Capital. Napier Park separated from Citigroup's alternative investment arm, Citi Capital Advisors, in February 2013. Prior to joining CCA, Dr. Hoffman was a partner and leading portfolio manager at Carlton Hill Global Capital. He has been working in the fixed income market since 1986 when he joined Prudential Insurance as a research analyst. He then became a programmer for Gifford Fong Associates. Following the merger of Equitable Capital and Alliance Capital, Professor Hoffman worked for 12 years at AllianceBernstein and was a senior portfolio manager for the credit portfolios. Professor Hoffman also ran the credit trade desk at Alliance. Professor Hoffman has managed almost all sectors of the fixed income marketplace, including ABS, MBS, municipal bonds, interest rate products, and credit. Between 2004 and 2006, he was Deputy Chief Investment Officer at North Star Financial Services of Hamilton, Bermuda. Dr. Hoffman holds an MA in econometrics from Fairleigh Dickinson University and a BA in economics and computer science from, oh my goodness, it cut off. I didn't print it.
Rutgers.
Rutgers. Yeah. And he is currently assistant professor of professional practice at Rutgers. So
at the business school.
At the business school, yes. So with that, I will turn it over to Mike, who's going to share his screen.
All right, let's see. All right, are we good?
Looks great. Yep.
Okay. All right, thank you, Janet, for the intro. Appreciate that. So yeah, like she said, my name is Mike McCormick. I'm a member of the Sweeney Group at Morgan Stanley. So what we are basically is we're a wealth management team employed by Morgan Stanley, and we're based out of downtown New Brunswick. Just kind of like any big bank, Morgan Stanley has local branches. So we're in the New Brunswick office, although we have clients all over the country and even the world as well. So, and what we basically do is we build and manage comprehensive wealth management plans for clients, for higher net worth clients. So anything from financial planning, estate planning, tax planning, and investment management, all those things wrapped into one is what we do. On this page here, you'll see the lead partner of our group. Her name is Kate Sweeney. Kate's a graduate of Rutgers, two-time athlete, lacrosse and basketball. I graduated in 2018, so I've been at Morgan Stanley full-time for 3 years. I started as an intern in college, though. And I've been with Kate ever since, Kate in our group. So as Janet said, we like to make this as interactive as possible, just because I've done a few of these since COVID hit, and prior to COVID, I did a couple at Rutgers, which is a lot better in person, but we'll make do with what we have. And so Fred and I today, we're gonna share some insight on investing, on financial planning, and best practices, and in terms of managing your finances early on, your mid-career and late career, basically all throughout your life. So like I said, if interactive as possible. So if anybody has any questions, type it in the chat box. I'd first just like to mention that some of this stuff is going to be really important. Some of it really might impact you, because the unfortunate fact is that this kind of education isn't provided enough in college, in higher education especially. I think in New Jersey it is a requirement now for kids to take classes in personal finance, but in higher education it's not. So it's an unfortunate fact, but that's what we're here for. Like, I love to volunteer and do this type of these types of presentations. So we'll get started. Let's see. All right, so I like this slide a lot. So it's a big number. 44% of Americans claim that personal finance is the hardest thing to discuss. So if you're in a family where your parents have brought this up, have brought up, how to run your finances, great. Most people don't, though. Most family members, most parents don't bring it up early enough. That leads to three things. First thing is passing on bad habits. That's going to eventually make you, not bring it up to your kids if you want to start a family eventually. A lost opportunity, meaning, if you don't start early, which some other slides we'll get to, if you don't start early, it's going to be really hard for you to catch up. And procrastination, I mean, I did it, everybody does it. It's not good to ever procrastinate, especially when we're talking about investing, because you'll see in the coming slides, like, the earlier you start, the better off you are, the easier it's going to be. So here we have a bunch of questions. I mean, these are all questions that our clients ask us that you should kind of be asking yourselves, and hopefully we'll touch on sort of each one of these. So, the market's up, should I sell? Am I saving enough in my 401k and my retirement accounts? The market's up, should I be buying? All these different questions that we'll kind of touch on throughout this slide deck today. So this is essentially how we help people, all in one slide. So we help them by setting their goals and achieving them. That's what we do with our clients. So clients in their early and mid-career, what do they want to do? They want to start a family. They want to buy a home, build an emergency fund, things like that. Your late career, maybe upsize, go into a larger home. Maybe you want to send your kids to college or higher education, graduate school even. Planning for future healthcare and retirement ultimately. And the last kind of section in life is your retirement. So what do you want your retirement to look like? What type of income do you need to sustain how your life was prior to retirement? Do you want to leave money behind to your kids? Do you want to have a legacy? You want to buy a second home, maybe vacation home? So this is really how we help our clients, all kind of in one slide. So Fred's going to go over these next few slides. So really pay attention, because this is where I'm saying the earlier you start, the better. Very important. So take it away, Fred.
All right. As a backdrop, I just want to tell everybody to exhale a second. We understand that you're in college, right? So when Mike and I are talking about millions of dollars and lots of money and high net worth, we don't want you to be scared off, right? I doubt, I will take the other side of the bet, that a number of you have a couple $100,000 or a couple $1 million in your bank account yet. What we want to get you thinking about, you're working hard, you're going to school. This is going to pay off for you. The main point of this is you can't really wait till it pays off to start thinking about it. If you wait till this pays off, and you're in your 40s and the paychecks start rolling in, you're already behind the 8 ball. So take a step back. Like I said, don't let the numbers scare you. And with that, we'll move forward. So what we want to talk about here is the power of compounding and the power of time when it comes to investing. Right? Power of compounding, power of time. Those are probably two of the most important things we can come up with in the world of investing. Right? So saving now is really important. So let's go over here. This is someone that doesn't start putting money away till they're 40. And for illustration, both people are putting away $10,000 a year. It's down at the bottom. So both people are putting away $10,000 a year. Now, my point here is you guys are going to start making money when you're 40. This is only going to compound. You're only going to double your money, right? You're only going to $581,000. But if you're 25, and granted, my problem with this illustration is at 25, you probably don't have 10,000, but bear with the exercise. You're going to more than double. You're going to more than triple. Your money is going to grow almost 5.5, 6 times. Two things are going on here. A, yes, you're putting money away for 15 more years, but it's the power of the compounding. So you're going to have over $800,000 more if you start early. Most of that 800,000 is the compounding. So the whole emphasis of the slide is start as early as possible. This is just a fancy way of saying that. Start as early as possible. Even if it's only $1,000 this year, even if it's 900, but the whole idea is you want to start now. Go ahead, Mike. All right, and this, again, same graphic. Now here, this one's a little more powerful. So Mike, you point to Alex real quick.
Yeah.
Alex is only putting away $3,000 a year, but Alex started at 30. Jordan tried to catch up. Jordan waited till she was 40 and put in 4,000. So if you look at the amount invested, Jordan, Taylor, and Alex, right? Jordan and Taylor played catch up, but look at the end result. All three of them put in $125,000, but you could see how much better Alex did than Taylor. All that difference, once again, is Alex actually put the same amount of money in, but it had more time to grow. Next slide. Everything on this page, I'm not going to talk about because this is actually a 3-credit course. So we're not going to do that in 45 minutes, but I want to go over at least the big 3, right? At your level, at your age, and at your income, right now, you should be focusing on equities. Why? Because you're young, you could take some more risk, and you could take more volatility. When you're old as me, and the equity market goes down 20%, I'm not real sure when it's coming back. So I'm going to have a balanced account of fixed income, which, by the way, is bonds, alternatives, because they have what we call a higher alpha, and I can afford to try to buy alpha, and I have some equities. Now, before you ask, because you're all bright people, where's cyber? In about 3 years, this slide will have cyber. Not cyber, it's crypto. Crypto will be down here somewhere. Whether you choose to buy crypto on Robinhood is completely up to you. But these are the big 3 asset classes. So I'm going to stop here for a second. Is there anything in these little boxes? I hope the big 3 are self-explanatory. Anything in the little boxes that somebody wants to ask a question about?
Well, actually, Fred, there is a question about your previous slide a little bit. Or maybe, I mean, you can stay on this, go back, Mike, you can stay on that slide, but the point of, if you're already close to 40, how do you make up for lost time?
So if you're already close to 40, get started, right? Don't put in that, don't come back 2 years from now and say, I just turned 40 and I haven't done anything. So the first thing is get started. The second thing is, and Mike, I don't think we have a slide for it, but you can go online and you can look at number of years to retire. So you're almost 40, you want to retire at 65. There is going to be some pretty generic cut and dry information on what you should have for for your ratio of fixed income to equity. Now at 40, I think you should be almost all equity and some fixed income. That's the balance. The actual nut and bolts operation of that, if you, and I don't know how much money you have in New Jersey, so I'm going to give you two separate answers. If you don't have a lot of money, we're talking a couple $1,000, I suggest, well, Mike, how much does someone need to become a Morgan Stanley Sweeney Group client?
It depends, but our minimum, let's say, like our average client is usually a couple $1 million, usually 1 to 2 million.
Right.
So,
So I wanted him to say that. So now, you okay if I say Schwab in here, Mike?
yeah, sure.
Okay.
That's fine.
If you have less than $1 million, we'll go with that assumption. I highly recommend Charles Schwab. I think their tools and their pricing are as outstanding. But once you get to $1 million, you call Mike, because once you get over $1 million or $2 million, there's these things down here that you're not going to find on Schwab, and there's other certain tools and tax things, and things just change when you get over $1 million. But I would say go to Schwab. Our funds and equities, mutual funds.
Yeah, I think we need to reframe our
I understand.
our financial mindset. These are people who are earning at most like $33,000 a year and living off of all of that. Rachel has her hand up, so I'd like to call on her.
Hi, yeah. Can you quickly explain the difference between large, mid, and small cap?
Sure. But let me address the first question. Funds and equities to Ange. Yeah, I mean, once you go on Schwab, you're going to see a selection of ETFs and mutual funds. That is what I would do. I do not recommend buying individual stocks, and I don't want to spend a lot of time on GameStop and Reddit and Robinhood and all that stuff. I don't recommend that. I recommend you buy ETFs or mutual funds at this point in your life. When you say get started, can I throw all my savings in investments?
So the question is,
yeah, it's taking me a minute. Yeah, I mean, you should always have a rainy day fund, and you should always have liquid investments. And as you get further along in your money, you start to have illiquid investments. But yes, never invest all your money into one thing. You need to have diversity, and never invest all your money. You should have cash. Now, whether that cash is, Mike, you just circle the upper left-hand corner.
Mm-hmm.
Right. Whether that cash is something it takes you a day to get to or something you want to check, that's a different animal. Is a liquid a liquid investment is something you could turn into cash in 1 or 2 days.
Yeah, we have a slide later on that kind of shows how, if you have what you should start saving for first, and then on down the line, a generic slide that shows that. So
let me pound out a couple of these questions. Indeed, crypto is not an alternative yet. I think my quote was, it probably will be called an alternative in 5 years, but a lot of people are using it in their portfolios already. So the answer to your question is yes, it is, but mainstream has not considered it yet. Dividend technically is part of an equity portfolio. Coupon and interest would be part of a fixed income portfolio. And I'm completely sorry, someone asked the question and I whiffed. What was the question again?
Was that Rachel's
this
question?
section here, right?
Rachel's question.
Yes, the difference
Thank
between
you.
the large cap,
Yeah.
small cap.
Thanks, Rich. It's size, right? So if you think of a company, Microsoft, Amazon, giant. So CAP, let me tell you what CAP stands for. CAP stands for market capitalization. So it's the size of the company. So any company you think of in your head, right? Microsoft, Dell, blah, blah, they're a large cap. if I showed you a list of mid-cap companies, honestly, you would say, I have no idea what any of those companies do. I've never heard of them because they're smaller and they're niche-y and they're not part of the, they're smaller companies. Usually a small cap company will have capitalization of less than 100 million. Mid cap will be about 100 to 600 million, and a sort of above $1 billion or $1.2 billion, you're into large cap. Now we have $1 trillion companies, right? What is capitalization? Capitalization is simply the number of shares times the price of the shares. That's what capitalization is.
There's another question. Can you please explain absolute return and equity hedge assets?
Sure. An absolute return strategy is a hedge fund that tries to put up a positive return every year. So maybe the absolute return strategy would promise you 2 to 3% a year. So absolute is sort of, if you think of the absolute value, it's positive, right? Your ABS function in Excel. Equity return, private investment, real assets try to beat the market. So this may sound a little weird, but I ran tons of hedge funds. My job was to give people 80% of the market upside, but only 20% of the downside. That would be a hedge fund. Now there are so just as long as I'm doing slightly better than the market on one side or the other, investors will reward me. There are some hedge funds which are aggressive and they might promise you always to be better than the market. But if the market's down 7, a good hedge fund might be down 3. That's different than absolute, which always tries to be positive.
Okay, there's lots of questions coming in. As you mentioned, the power of compound interest, which investment options should I look to that utilize compounding? Oh, wait, and there was another question from Danielle about the difference between mutual funds, bonds, and ETFs. What are the benefits of investing in each?
Mutual funds and ETFs are different. All right, I would say as a general rule of thumb, so let me put it this way, $4 trillion has left the mutual fund industry and gone into the ETF industry because the fees are lower. But that doesn't mean you're going to choose the right or the wrong ETFs. Right. So I'm not going to sit here and say ETFs are better because you might choose the wrong ones, but generally your generation is moving more to ETFs and out of mutual funds. Oof. Exhale. Anything else?
Yeah, I think we're starting with a lower level of knowledge.
How do I feel about a big amount of your rainy? No. Okay, anything that yields 8% is risky. It's very risky. So no, you don't hold your rainy day fund in something yielding 8%.
Did we answer how many months of expenses you consider as a good emergency fund? I think that was, so for those of you who didn't attend our workshop, I guess a month and a half ago, I have a recording, but of that I can share with everybody, which talks about that sort of thing, but maybe Fred or Mike, you could comment on rainy day fund.
What's the general
rainy day
rule?
fund is general roof is 3 to 6 months. We like 6, closer to 6, just in case you do lose a job and it takes 6 months to get another job. So
Yeah,
three at least 3 of your monthly expenses.
right.
Is it a bad goal to have a year just in case? Because obviously something like a pandemic would,
It's not a bad
No,
goal
not
at
bad
all. Here's a job, but let's you start making your first job. I would get it to 6 months and then invest a little and then get it to 8 months and invest a little bit more. And then, you know what I mean?
Did we talk about compound interest?
Compound interest.
Which investment options should I look to that utilize compounding?
Sure. Generally, most people consider compound interest to be the coupon paid off fixed income investments. But if you have high yielding dividend stocks, if you have high yield dividend stocks, those dividends will also compound. Remember, all compounding is you're taking cash flow, right, which comes off your investment, and you're reinvesting it again and again and again. That's compounding. So if you think of the formula real quick, it's 1 plus T. T is your 1 plus R, do it that way. It's your interest rate raised to T. So you're just compounding along. All right. So if I make $1.10 the first year and $1.10 the second year, I don't have a 20% return. I have a 22% return.
ETF versus mutual funds, any appreciable difference in tax
None.
benefits for a grad student earning only 25 to 30,000?
None.
Okay.
Okay, to answer her question, go to the, I think Charles Schwab is the best resource to go to.
This, right.
Schwab.com. I highly recommend.
Schwab.com. And they suggest, for those of you who might have joined a little late, they suggested that for most of your earning level, that Charles Schwab would be a good company to help you invest. So, I mean, I guess what you're saying is you don't recommend individual graduate students decide to like buy and sell on their own. They all should use a financial advisor. And what are they paying for that?
Well, no,
service?
Schwab's going to be at Schwab at their level. They're not going to get a person. They're going to get a ton of information and a ton of different investment ideas that they can execute themselves. I don't think you're going to go and get a person at Schwab, probably to 100,000. But, you know, are they eligible, by the way, since the PhD students, are they getting, is their stipend eligible for 403Bs?
No.
Okay. So first thing, let me make this really clear. The first day you're out of here and you get a real job, that you're working 5 days a week and there's a W-2 and all that, the first information session, someone's going to talk about 401k or employee savings or something. Your job is to check the box that maximizes not only your money, but your company match. And let me explain a company match real quick. For example, I'll use one of my old firms, right? If I put 5% of my money away tax deferred, my old employer would match my 5%. That 5% is free money, folks. It doesn't come any more free than that. So when you get out of here and you get the real job, check that box. Take as much free money as you can. The other thing I'm going to tell you is you're going to say to me, wait a second, putting away 5% of my money is a lot. It's still your money. It's not like you're donating or giving away 5% of money. You're going to get it back. And maybe you have a couple less beers a month or live in a slightly smaller apartment. So I'm not a tax specialist, so I can't actually answer that Roth question.
Mike, do you know both?
Yeah, some of these questions they'll actually be answered a little bit
Okay.
later. So
Okay, let's keep moving.
yeah.
Great questions, but by the way, Rachel, did I answer your question?
Yes, thank you.
Okay.
This is kind of similar as the last slide you touched on, Fred. So
Well, let's just go right here. Stable income stream, right? So age-based, as I mentioned, you guys at your age and your income should be mostly equity, right? And there's probably in here, we're going to have like the age graph. As you become older, you start to add more fixed income. But yeah, let's move along.
yeah, that'll be a little bit later.
Okay, here, you guys asked this question. Mutual funds there's some specific mutual funds which I think are really good to use, right? When you guys go on Schwab or you go on Fidelity or you see something like that, you'll probably see these things called age-based. I don't think they have age-based ETFs yet. So that might be one way. You just put your money in and you have professional managers rebalancing your account and finding you securities, that is the easiest way to do what we're talking about. Literally just buy an age-based mutual fund and leave it there for a while. ETFs, if you're really the kind of person that wants to do stuff themselves, then you can, I'm a big ETF fan, right? We at the business school have a couple courses on ETFs. I love ETFs. You can manage risk and all this. You guys are PhD students. Worry about getting your PhDs for now. Let the mutual fund person figure it out, but both have advantages and disadvantages. I'm going to leave it there.
Okay, so yeah, when Fred was using the word equities, what that really means is stocks. So this is the S&P 500, which stands for Standard & Poor's, which I'm sure many of you might have heard of. It's the generic the benchmark that a lot of the investment world works. So what it is the 500 biggest companies in America. That's what this is. So what this is just to show you is that you shouldn't be shying away from investing in the market. You know, if you're a little bit timid about it and you know, you don't want to put your money in stocks, what this shows is over the long term, you know, the market is a steady increase. So I mean, you can see the COVID crisis up in the upper right there. Whenever everybody thought the world was going to end last year, you know, it's barely a blip on this chart here. So, you know, it shows that don't be scared of getting into the stock market. You know, it can really benefit you in the long term.
And look, if we were to draw a straight line for this in our regression, sure, there's times where it beats the slope and we call that a little bubble, and there's time, but people that are good at finding market tops and finding market bottoms, that's their full-time job. Right? Almost impossible to do as a professional, impossible to do as an amateur.
Exactly. This is one of my favorites here. So this shows that you know, if you try and time the market, it's virtually impossible. Like Fred just said, this is intra-year declines and where the S&P 500, the U.S. stock market ended up at the end of the year. So the blue line is where the market ended on December 31st each year. The red dots all below is at some point during the year, the market was at that point. So let's say last year, for example, 2020, which is right here. So the market ended up 16.3%. That's what it increased from January to December. At some point during the year, though, in March, it was down 31%. So the market was down 31%, and people were going nuts. A lot of people were selling their investments and going crazy. It's such a psychological thing. And these people that sold, you know, near the bottom or at the bottom here, they missed on this whole 47% upswing. They totally missed out on that. And, you know, those people, they probably when it got back to zero or a little bit above, then they're like, okay, it's safe to buy back. But they missed out on 30+% return. So what this is really showing is stay invested, you know, have a investment plan where you invest X amount a month into your 401k or 403b or your IRA, wherever you have that set up, once you do set one up, and just keep it going. Keep it going.
Yeah. The two mistakes.
I just saw somebody have diamond hands. Yeah.
The two mistakes most people make are they don't start soon enough and they panic at the bottom.
Exactly. Yep.
Yep.
All right. So now we'll get into types of accounts. So this is very helpful for you guys because eventually, you know, you're going to have one of these accounts if you don't have one already. So first one here is a 401k. So same thing as a 403b, which if you're employed by university, some of you might not have it yet, but you will eventually. So you'll have
I think
a 401k.
postdocs can have 403bs.
Postdocs? Okay.
Yeah. So there might be some postdocs on here.
Yeah. So, yeah, if you're a postdoc, get started on your 403b if you haven't already. And what it does is when you make a contribution, it's tax deductible. So let's say you make $50,000 a year and you put away 10 of that.
Right.
Instead of the government taxing you on your $50,000 salary, they're only taxing you on 40,000. But what that means is you're deferring it. You're deferring your taxes. So when you pull it out, which when you turn 59 and a half, you can start pulling it out without a penalty. You have to pay taxes on it then. And the hopes is that over time, as you make more money, you're going to want to contribute more and more to this so that you get that tax deduction on the front end, and you get the whole tax deferred growth, meaning government doesn't tax you on any of those investments. You can buy and sell and do whatever until you start withdrawing it. And the hopes is that when you retire, instead of you being in a 6-figure tax bracket, being your tax rate at 30-40%, you're going to be in a much lower tax bracket. So instead of paying the taxes on the front end at 40%, you're going to be paying it on the back end when you withdraw it at hopefully 15 or 20%.
Amen.
With Roth IRAs, I saw somebody put in here earlier, what's better for low income? Yeah, generally a Roth IRA or Roth 401k is better. So if you're only making $40,000-$50,000 a year, it could be definitely beneficial for you to put money into a Roth. You don't get that tax deduction on the front end, meaning it's after tax money. It's money that you got in your paycheck already taxed, and now you're contributing to the account. It's still gross tax deferred, meaning it's not present tax. So it can grow from when you're 30 all the way to 60, not taxed in that time frame. And even when you withdraw it, it's tax free. After tax 401k, so that's for your high income earners. So hopefully all of you eventually. That's if you're maxing out, meaning putting your total max in your 401k, which I believe is 19,500 nowadays. And say you're contributing that max at 19,500, and you have more discretionary money that you want to put away. Great, you can put it into another traditional IRA outside of your 401k, but it wouldn't be deductible. But it still would grow tax deferred, which is a big benefit. And a health savings account. So what that is basically a card, a plan, a debit card where you can use to pay for health expenses. You can contribute to it tax deductible, meaning your tax, you don't pay taxes on it on the front end. It grows. You can actually invest it, and when you withdraw it, it's tax free. So this hits all the buckets, all the check boxes.
And Mike, that's true for it. Does that work for childcare too? The
health savings, yeah. If you have a family plan and you qualify for health savings, yeah.
Not health for children, but like daycare. No.
Oh, daycare? I don't believe so.
I used to put money into a fund that was tax free for daycare.
Okay.
I have both a Roth IRA and a pre-tax 401k. So it sounds like because I'm making not as much income now, I should probably feed the Roth more than the 401k until my income gets to a certain level and then switch that. Or what do you think? That's what it sounded like, which you were, I guess, implying.
So you have a Roth IRA and just a regular 401k?
Yes.
Okay. Do you have a Roth 401k option?
No.
Is it through your employer, or do you do it on your own?
The 401k is from my previous employer, and the Roth is my own.
Okay, so the money's already in the 401k from your previous employer.
Yeah, and I'm not really, I haven't been able to that was my old job. I'm not employed there anymore, so I haven't been able to put anything in it.
Yeah,
It's just the Roth that I'm feeding now.
Just
Yeah,
leave
you
that
won't
there.
be-
Just feed the Roth.
Gotcha.
Mhm.
There are a couple questions.
Yeah, I saw that.
Okay. Whoop, they're coming in
I can
fast
take a
and
couple
furious.
of these.
Okay,
So
so
I got it.
I think starting with Allison. So are you saying not to worry about when we actually buy in terms of trying to quote time the market?
That is exactly what we're saying.
Exactly.
Okay. Do you recommend we put our emergency fund? Where do you recommend we put our emergency fund so that we have easy access, but it's making a little money for us? So those 3 to 6 months, where should that money be
That's
held?
like asking for Coke and chocolate that doesn't make you fat. They don't exist.
A savings account, I guess, right?
Yeah,
Savings
I mean, the
account.
savings account is not gonna make you a lot of money, but that's why it's a savings account. I mean,
You can go to bankrate.com. They always have the top banks that are paying the most interest. I mean, it's very near zero these days. I mean,
Right.
you can find, if you're finding an account that has 1%, that's
it's a home run.
amazing.
Right.
So you can jump on that.
You're just gonna get, and look, if you're not talking about a ton of money, the difference between 1% and zero is like 10 or 15 bucks a year.
Mhm.
Mhm.
Just be happy. I mean, I hate to say it, in this world, be happy with a checking account that pays zero. It's just the world we live in.
Mhm.
I know if you're a US citizen, a Barclays account could get you about 2% right now, and it was up at 3 for a bank account savings. So, but it's only for US citizens. So
Okay.
Okay.
Thank you, Josh. Okay, Danielle asks, is it possible to put money into Roth IRA and then use that money to invest?
All right. So let's move everything on this page. I think maybe we need to stay. So your 401k, think of it like a box, Danielle. It's a box of money. Right. Once you have the money in the box, then you can buy mutual funds, then you can buy ETFs, then you can buy, if you wanted to, individual stocks. Right. So yes, everything on this page, except for, I don't know about the HSA, we're gonna leave that, but the first 3, you're going to create these pools and boxes of money, and then you're going to figure out how to invest them. I
Okay.
can't seem to figure out if my 401k is in different stocks. Liz, you need to be your own advocate. You need to get on the phone or on the website to figure out where your 401k is, and you can answer those questions. But
Yeah, you can
wherever-
go in on your portal, your 401k login, and
yeah,
load a statement or click around and look for the different investment options.
if you have to, get out the 800 number and get on hold for a little bit, because it's your money and you have the right to it.
There's a question about, can you explain the HSA, what you mean you can invest it? What do you mean you
Yeah,
can invest?
HSA, so it's an account that you can use towards qualified health expenses. So going to the doctor, anything like that in that realm. And you can actually put it inside like more conservative funds. So you can buy a bond mutual fund or a money market fund within that account. So I mean, you deposit money into it, let's say $1,000. So you can actually grow the money and use it for expenses as well. So you can, depends on what kind of plan, what HSA plan is, and they all offer different investment options depending on your employer.
Can foreigners have an IRA? What if we move to another country when we're 60?
Foreigners, I'm not too familiar with how that works.
Fred, do you know about international?
No.
No.
Yeah. Well, 99% of our clients are US based. We do have a couple Canadian clients, they have very similar process, but in terms of anything outside of North America, I'm not fluent in that area.
Okay. Allison asks, you're recommending people park money into ETFs and mutual funds and just leave it there long-term over doing any kind of actual stock trading.
That's the best and easiest way. It's the method I use, even though I do this full time. I mean, nobody has all the time in the world to go and look at a cash flow statement and a balance sheet
Right.
of Apple and decide to buy Apple over Microsoft. I mean, there's professionals that do that, and there's professionals that do that and manage mutual funds and ETFs. So that's the easiest way. Mutual funds and ETFs.
And Allison, we're not, I always found this is, as you guys get older, you'll find this amazing. So you go to a cocktail party and, you know, I'm in my 40s and I'm running funds and I'm going into the city. And I always have doctors, like medical doctors, not PhD, go, oh yeah, I do it all myself. And my response would be, what if I told you I wanted to operate on myself? Well, you can't do that. You didn't go to school. You don't have the knowledge. You don't have I'm like, right. I've been doing this for 30 years. You shouldn't be buying stocks and I shouldn't be operating on myself. There. I'm going to leave that there for all you PhDs.
Yeah.
Okay. You
All
want to
right.
move ahead?
Yeah, I'll try and run through these a little quicker because I know we're running out of time here, but just another little breakdown. So personal IRAs, if you're not employed by somebody who offers a 401k or 403b, you can still contribute. You can still contribute to a traditional IRA or a Roth IRA. If you're employed by a small business, sometimes they offer these different plans, a SEP IRA, simple. You don't need to worry about the acronyms. What all it is it's very similar to IRAs, but instead the business would contribute for you, which is nice.
Once again, I can't emphasize enough the most important thing. If you have a company match, grab it, grab all of it, grab as much as you can.
Definitely. So kind of went over this a little bit already, but traditional IRA, so tax deferred growth, meaning you're contributing on the front end, you're not paying any taxes. It's tax deductible. Non-deductible contributions, that was the portion where if you're already contributing to a 401k and you're maxing it out, you can also make traditional IRA contributions outside of your 401k if you're able to with that discretionary money. And once it was starting at 59.5 right here, you can take money out without a penalty. If you take money out before that, it's usually a 10% penalty, unless you're doing a couple of things. So one is buying your first home, you can actually take money out tax-free. And another one is if you're disabled as well. And your Roth, so similar thing as I mentioned before. You pay the taxes on the front end, and when you take it out, it's tax-free. So there's actually income limitations for Roth IRAs as well. So those you definitely want to look at when you're younger and making less money than you'll eventually be making in your mid to late career, because you could be making too much eventually, and you won't qualify to contribute to a Roth. I think
Right, it won't kick you out. You just can't put more money in.
Right. This is kind of a generic sort of target, so what we mentioned earlier. So when you're young, these are retirement dates. So if you think you're going to retire close to 2060 or beyond, all stocks. So and you know, the dial just goes back and back, just like Fred mentioned. If you're going to be retiring in 2025, this is kind of what you want your breakdown to be. The light blue is bonds and dark blue is stocks. You know, not exactly, but this is
there's plenty of mutual funds out there for high net worth people, for there's plenty of mutual funds and ETFs that actually do this rebalancing automatically. And they're pretty good products. I mean, you can't sit and say, oh, it didn't do what the market did, because it's not 100% equity. So, but it does its job. We got a couple questions here. Let's
Actually, I was wondering if we could just finish the presentation. So
Yeah,
in
okay.
case people
That's
need
fine.
to leave, but I think these are excellent questions, and hopefully you guys can stay a little after to answer the questions.
That's fine.
think we only have a couple left anyway. So, so yeah, here's your priorities. I mean, there's no exact formula to all of this, but these are generic things that you can kind of follow and use for yourself. So what you first want to do is when you get your first job and want to start saving, build up your your reserve. So your emergency fund, 3 to 6 months. Start with that, because you know, if what we always say, if the fertilizer hits the ventilator, you know, and you lose your job, you want to have some cushion so that you can get back on your feet. Two, what I mentioned earlier, health savings account, or just start a healthcare plan with your employer, either one. And then this is number 3 is tax deferred. So this is your 401k, defined contribution. That's a fancy way of saying 401k or 403b. Start with that and maximize it if you can. You might not be able to start, which is fine. You know, takes a few years to be able to do that. But that's number 3. Number 4, any debt that you might have through school, pay that down. If you want to contribute even more to your tax deferred savings, your 401k, 403b, great, do that. And then if you're maxing all of that out, you can contribute to an outside IRA, as I mentioned earlier. And if you do all that, that's when you can really start using a brokerage account, which is not tax deferred. It's after tax money. After you've maxed out your 401k, after you're paying your debt down, after you've contributed to an individual account outside of your 401k, individual retirement account, IRA, then you can open up a brokerage account if you have all that discretionary money. I mean, it's going to be tough to get to that point right out of school. But you can do that and do the same thing. Just buy mutual funds and ETFs and keep it simple.
Yeah.
Don't want to make it
So
complicated.
7 is mutual funds and ETFs when you say taxable account. And
Well,
yeah.
actually, 3 at 3 you'll be owning mutual funds
through your
and
employer.
ETFs.
Through your employer.
Yeah.
Sorry about that. And I think this is our last slide here. So this is like I said, all these are generic type of formulas, but you can see here. So this is like a checkpoint type of thing. So let's say you're 40 and you make $90,000 a year. This is kind of where you want to be at, right around this $230,000 number in terms of how much you have saved. If you want to keep your current lifestyle and have that lifestyle in retirement.
So if we have current students, or let's say in their close to 30, in their late 20s, and they're earning $30,000 a year. So they should have 6,000 already saved for their retirement. Is that what I'm reading?
Yeah. I mean, the students who are 30, they're most likely still in school, PhD.
Right.
Yeah.
They're
So
yeah, that's who's on here.
yeah. So yeah, 30,000 and right, 6,000. But I mean, the hope that, you know, everybody's a PhD student. Hopefully you're going to be very successful. So
Right.
You'll be able to save a lot more than somebody who's 22 just graduating with their undergrad degree, bachelor's. You know, once you get your first real job out of PhD school, you'll be able to save a lot more aggressively than somebody who's a lot younger. So
And just, yeah, this is for a single person or somebody who has a family?
yeah, household. So household, you know, I'm not sure what our assumption is here, actually. That's a good point. But household, I think this is just assuming you know, that maybe you have a partner and maybe 1 or 2 kids. Yeah, household. So
Okay. Great, thank you. So we have a bunch of questions. Let's go back. I think Hadi's was, No, maybe not. What if we diversify our stock matching S&P?
Once again, I would take a look at some of the stuff on Schwab. Look, S&P is 500 large cap stocks. That's pretty well diversified, but it's also kind of risky, right? It's kind of volatile. So if you're a risk lover, that's fine. If you're a little less of a risk lover, maybe you want to put 60% in the S&P and 30% in a bond ETF and 10% in something else. But most market participants will tell you you can't go wrong just putting all your money in the S&P 500.
Okay. What are your experiences with wealth advisors? How do you find one that you can trust? They often ask for very detailed financial information, savings, stock, 401k, etc. It feels scary to have one. Haha.
Yeah, that's a great question. I mean, so that's the business that I'm in. I work with a wealth advisory team. How do you find one? I mean, you can ask around, you can network with your current network, see if anybody has one, if they like them. They definitely ask for very detailed information and the more you can give, the more they can help you. We always tell our clients, like when you go to the doctor, do you hide things from them? And the answer 10 times out of 10 is no. You don't want to. You want to tell them your whole medical history so that they have a good base of how to help you. And same thing with us. You want to give them all the information you can, because the more we know, the better we can help you.
Good analogy. So the 6,000 max annual contribution does not apply for a traditional IRA?
Yes, it does. For a 401k, it's 19,500 or 403b, depending on what you have. For a traditional IRA, if you're not covered, if you don't have a work 401k or 403b plan, $6,000 is the max. And if you're over 50, 7,000 is the max. There's a $1,000, they call it a catch-up rule, which you can contribute the extra 1,000 if you're over 50.
Okay. If you want to buy a house, can you take money from your 401k without tax? And if my money is not in a 401k, but I want to buy a house, should I keep that money in a savings or invest it differently?
Yeah, so if you want to buy a house, your first home is the rule. So you can take it out without any penalties. You'll have to pay the income penalties on it. So, since it went in pre-tax, you didn't pay tax on it. When you pull it out, you'll have to pay the income tax on it, but you won't have that 10% penalty. And you have to prove that this is your first home and you're going to be living in it. It can't be an investment property. But yeah, if you don't have a 401k and you want to buy a house, it depends on how far out. So if it's only
A couple years
out,
1 to 2 years.
Oh yeah, 1 to 2 years out. So yeah, 1 to 2 years out. I mean, if we had a crystal ball and knew the stock market was going to go up 10% this year and 10% next year, I'd say,
right,
sure, go ahead, put it in stocks and have it grow. But nobody really knows. If you have $10,000 that you want to put for a down payment, it could turn into 5 really quick, at really any point. But 1 to 2 years out, you can put it in something, more of a conservative investment, like a bond mutual fund. Wouldn't go further than that.
Yeah, short-term investment's a lot harder than long-term investment. I'll leave it there. So the 1 to 2 year questions are a lot harder for us or anybody to answer than 30 years. We kind of know what's going to happen in 30 years.
Mm-hmm.
Lauren asks, where would you suggest additional mortgage principal payments fit into your savings plan? Is that part of number 4?
That's a great, that wins question of the day.
Mm-hmm.
Lauren, here's the problem. Once you write that check to the mortgage company, you can never get it back. That's the hard part. So here's my advice. And I don't know, Lauren, I don't know if you have an accountant or you're doing it yourself or whatever. You're borrowing long-term money. We call it non-recourse. It's a fancy word. you're borrowed non-recourse tax deductible money. That's a gift. Right? There are billions of hedge funds would love to run around and borrow non-recourse. So this probably flies in the face of what Mike might say, but I'm never in a big hurry to pay down my mortgage. Because if I need it, I can't call the mortgage company and say, hey, by the way, that X thousands that I prepaid last week, I need it back. It's a one-way trap. So
Yeah, I completely agree.
Yeah.
With that, Fred. And
To maybe follow up on that, could you view a house as an investment itself if it's appreciating value? So if you pay off that
Houses-
mortgage
houses
and
have
it
always-
appreciates in value, then couldn't you
Hey,
sell
Josh.
that and invest the profits elsewhere? So
Hey, Josh.
maybe as a question to that, like maybe is it in some cases good to pay off the mortgage quicker?
Houses have only depreciated something like 10 out of the last 50 years in this country.
yeah, real estate is yeah, my group in general, our view on real estate isn't owning real estate, specifically investment properties, isn't too great. I mean, if you buy a house and you have somebody rent it and your tenants are great and they pay you all on time every month, yeah, it could be good, but there's so many other things that you got to take into account, because if all those things go haywire, it could turn into a bad investment real quick, and we've seen that happen many times with clients. But our whole thing is, if you do that, you do get a return on a percentage basis from your income investment.
Well, Josh, were you asking it from the house you live in or as like?
Oh, in general, because the longer you pay your I guess I'm looking at the longer you pay your mortgage, the more interest you're paying. And if you were able to maybe get like a 15-year mortgage, you pay it off quicker, and your house appreciates in value, even if it's a couple, 2-3%, you could sell that and then take the profits of the house and invest it again. Or you could maybe get in real estate if you had enough skills to get into real estate. So that's kind of what I'm looking at.
Yeah, but all you're getting, so at the I'll try to make this real simple. If you sell the house for $100,000 and it's got a $50,000 mortgage on it, they're going to hand you a check for 50 grand, right? You agree with that?
Yes.
If you sell a house for 100 grand, but you've paid the mortgage down to 25,000, you're excited because you got back 75,000, right?
Yes.
Whose $25,000 is that?
That's yours, right?
It's yours. It's a zero-sum game. So my point is, you might be compounding at 3% in your mortgage, but that's tax deductible. But you might be compounding 5% in your IRA. Do the math.
Mm-hmm.
The mortgage is 1,000 times better investment.
So you're saying the money that you spend on the mortgage, the extra money you would spend to pay off the mortgage, you could just invest that and it would make more, it would yield more.
If you're patient, do it right. Yeah.
Mm-hmm.
Gotcha. Okay. Thank you.
Right. Because remember, the bank's not giving you back something that's not yours. All they're doing is giving you back your 25,000. It's not mystery.
There's some more questions. Does it make sense to pay down student loans more than the minimum if the interest is lower than the return on investments?
No. Same question.
Yep, definitely not.
Yep. Once again,
and Joseph says, for example, if he were to invest in an ETF instead.
Look, there's going to be, in an average 10-year period, the answer to that question is going to be no for 8 years and yes for 2 years. So we're trying not to predict volatility. But yeah, if I had a 20-year student loan at a low rate, look, my student loans were at 16%. So slightly different animal. Where are you guys borrowing at? 6%, 5%? I don't even know.
I don't know. 7%.
Mine personally I still have a little bit left. Mine's at 4. It's currently at 0.
Because you're all getting deferred.
Period, but
seven's kind of a hefty number, and that's not tax deductible, right?
And Josh says 12%.
I'm at 5 to 6%, and I've got offers to refinance lower.
Yeah, but that's not tax deductible. That's the difference. Mortgages are tax deductible. That's why I'm adamant on the mortgage. I'm kind of a push. If you're at 12, I would pay that puppy down as fast as possible.
There's a question. As a 25-year-old student who plans on beginning medical school in 2022, I know that I'm going to have to take a decent amount of loans. Let's say I have around 10K that I want to start investing with. Would the best way to be put that money into Roth IRA or a mutual fund ETF?
You're going to need that money. Do not put it in a Roth.
Don't put it in a Roth.
Just
If you don't need it, right? If you do need it, say you want to, I don't know, use it to buy something or
yeah.
Buy a house, put a down payment, need a car. Yeah, don't put it in a Roth.
Yeah, you're gonna. I'm going with the assumption you're going to be a starving medical student 2 years.
And you're going to need access to the 10K.
Right.
Mhm.
If you think that 10K and whatever grade school you go to is going to pay your whole ride, yeah, then maybe throw 5 of it in a 401.
I think the
5
concept is that the 10K is in addition to what is already allocated for tuition, I'm guessing.
Oh, if that's it, then solve your rainy day problem, figure out what 6 months is, and then invest the rest.
Mhm.
Right? Remember, always solve the rainy day problem first.
Liz asks, is there a maximum contribution for brokerage accounts? Max.
No.
Not for brokerage accounts.
Nope.
Okay, Rachel asks, is the main difference between an age-based mutual fund and a retirement account the ability to withdraw money?
No, they're just mathematical models. Age-based is just a mathematical model that adjusts your ratio between stocks and bonds as you get older.
Okay.
Thank you.
For those of us with small kids, what's the best way to begin
Oh.
investing for their future? For those of us who remain in academia, our kids might have free college. Don't count on it, Jessica. So what sorts of accounts would not be specifically dog-eared for college tuition, like a 529 is what I
So-
had. But
So Jessica, I'm a professor. I have 3 kids in college, and none of them are going here.
exactly.
Take that pipe dream and crush it. I hate to crush your soul, but
Yeah.
your kids don't want to go to school where you teach.
And that's usually the only benefit that you'll get. My brother teaches at Northwestern, and he got 10K off of wherever his daughter went.
So the short answer is 529.
Yeah.
Here's the balance. And like I said, I got 3 college age kids. You got to sort of between in your heart, if you have $1 to save, how much of that dollar goes into 529? Let's call her Jessica Jr. And how much of that goes into your savings, Jessica Senior. And I can't help you with that one. But once again, it's a zero-sum game. Right now, the good news is if you put too much money in Jessica Junior's and you don't use it, I don't think the penalty is onerous. I think it's 10% gross to get it back. So, but you gotta decide that one. But yes, both are tax-free. And I don't know if you guys know this, you can actually start 529 before your kid's even born. You can like pre-fund them. So
Yeah.
Is interest isn't tax deductible on student loans? Question mark.
I don't know. I kind of asked the question.
I think it is. I think it depends on the loan, possibly, but I think certain ones are.
Yeah.
That's a good question for Investopedia.
Yeah. Good question for your accountant.
Joseph says, I refinanced to Fed loan servicing to take advantage of PSLF. Working at Rutgers counts as public service. So a $10 a month right now is qualifying monthly payment on a payee plan.
That was a comment I made.
Okay,
Just
sorry.
somebody said that they're getting robbed at 12%.
Yeah.
And so, yeah. So this public service loan forgiveness, I hadn't known about this until a couple of years ago, that if you work in a public sector job that and do a pay as you earn plan, so it's an income-based repayment. Normally, if you're in the private sector and do that, and you after 20 years haven't completely paid off your loan, it gets wiped out and you get taxed for the remainder of the loan as a windfall. But if you're in public service after 10 years, it gets wiped out and you don't get taxed. And working as a grad student at Rutgers, a public university, counts. And so I'm making those qualifying, you have to make 120 qualifying monthly payments based on your income. And right now the income is diddly squat. So yeah, I'm making trivial payments on a monthly basis that have that clock ticking.
All right.
Rachel's asking, is that working at Rutgers as a TAGA?
Yeah.
Okay. I had a question. You didn't talk about long-term disability and making a plan for that. Is that something you recommend when doing what? Because if you put it in while you're, young, it's cheaper, right? Not long-term care, long-term health care, not disability. Sorry.
Yeah, that's a hot topic. It is very expensive, and the reason it is because decades ago, insurance companies really messed up their assumptions where
GE lost billions on this project.
yeah,
program.
they really didn't think people would submit a lot of claims around long-term care, but yeah, they did, and now premiums are pretty crazy. I mean, if you're over 50, it's quite a high number. It's very expensive. So yeah, if that's something that you want to plan for and you're willing to sacrifice a small amount, the premiums won't be crazy. Starting in your 30s, it will be a lot cheaper. The premiums will go up for sure. They do go up on average, like they've been going up the past few years about 5 or 6%. But yeah, like you said, Janet, it definitely is a lot less expensive. Any kind of insurance, life insurance, health insurance, long-term care.
I mean, the other way to do it, Janet, I've had this conversation with my kids, is I just have a lot of life insurance.
Mm-hmm.
Right? Because think of it, I've seen this, right? People buy long-term care and then you buy it and then you die suddenly. It goes to zero, it's gone, right? The other way is to buy a lot of life insurance. Tell your kids, look, if there's that 4 or 5 years, I really need nursing home care, I need something, you need to figure out how to borrow the money, because when I pass, you're going to get all this money and more back. And you're definitely going to get paid on life insurance because we're all going to die. There's no certainty you're ever, like, God forbid you get hit by a bus and you've just paid off your long-term care policy, all that premium went to zero. You got nothing back. So,
Interesting.
all right. Last thing you want to do is pay 30 years of premium and then not use it.
Right.
Right. Yeah, different for each situation, but
yeah. All right. I think we're done.
I think we answered all the questions that were in the chat. Any burning question that you didn't get to ask people? If not, thank you so much, Mike and Fred. This was very helpful. I know it's a lot for people to think about and process. And for those of you who want the slides, I will email it to everybody who signed in, and the recording as well. So you will have access to that.
Yeah.
And if
Remember,
you didn't sign in, it's in the chat.
The mission is start early. Start early and start, like, the earlier you start, the better you're going to be.
Even if it's small.
Just start. Yep. All right.
Okay.
Thanks, guys.
all right.
Thank you all.
Yeah.
Bye.
Bye-bye.
Thank you.